story. But let's bring in our first guest for the hour. We've got Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist. Jeffrey, a lot of layers to go through here, but it feels like increasingly we are hearing of a recession risk given the inflation risks that have materialized and obviously that being accelerated or magnified by what's been playing out between Russia and Ukraine. What does the data tell you?
The data is telling me that, at least in the near term, the risks of recession remain low. I think that's one of the reasons why stocks have done as well as they have. Today, we got the PMI, the Purchasing Managers Index for Europe, that downticked about a point for the composite index, but it was expected to decline even further, and it's still consistent with the level of growth in Europe north of 2.5% to 3%. So that's encouraging. Looking at weekly GDP trackers from the OECD for countries like Germany and Italy and France, they're not showing any major rollover here. And even looking at real-time data, things like weekend box office numbers or traffic congestion in major cities in Europe, or even open table dining reservations have not shown any kind of rollover yet. So despite higher gas prices and increasing concern over how long this conflict may drag on, we're not yet seeing signs of recession develop in Europe.
Now, I guess I kind of want to ask the question about the potential spillover effects, though, maybe if not from Europe, from elsewhere. A lot of questions, even from the Federal Reserve, about whether or not the Russia-Ukraine conflict could spill over into slower growth here in the United States. It sounds like the consensus is that for right now, probably not the case. The bigger risk might actually just be inflationary impact of higher energy prices. But what do you see on that front?
Well, I think that's the primary transmission mechanism of this conflict is through energy prices. You know, in order to rebalance global energy supply, it'd be great if China was at the table today with those discussions, because China really needs to rebalance those supplies. They need to absorb the supply from Russia, and then through their foregone purchases of maybe Middle Eastern crude, that can then find its way into Europe. That will take many months to take place, and there's, of course, a lot of risk of dislocation for energy supplies here in the near term, and that's where that can have an impact in Europe, in the US, in parts of Asia. So that's the main concern right now. And the Fed seems to be the only central bank still focused on increasing its hawkishness in the face of all of this. We heard from the Bank of England that maybe they're slowing the pace of their rate hikes, or at least a 50 basis point rate hike is off the table. Heard similar things from the Bank of Canada and other places. So it's noteworthy that the Fed has remained this very hawkish bent, even in the face of these accelerating risks around commodity prices.
Jeffrey, you mentioned China there. I'm reminded that earlier this year, the focus really was about opportunities and emerging markets, and it feels like that has kind of dramatically shifted over the last several weeks. What does your exposure look like in your portfolio right now outside of the U.S.?
We think that we actually think Europe looks pretty attractive, but emerging markets are not a bad place to be. Look, some of the markets are really benefiting from this elevated commodity environment. I'd note that Brazil is one of the best performing markets this year, up, I think, 10 of the last 11 weeks. Latin American equities doing very well, of course, on these higher commodity prices. And even Asia's doing okay. China certainly was suffering earlier this year, but then having the state council step in and say they're going to deal with this ADR issue. They're going to make sure property developer risks don't get out of hand, and that the big tech crackdown in China is, they said, quote, will end soon. A lot of these positive developments there saw Chinese stocks go up 23% in 23 hours. So we may have put in a bottom there, call it the China put, if you will, making it a little bit safer to hold those EM stocks in your portfolio.
All right, we'll have to keep posted on those developments. Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist. Thanks so much for stopping by this morning.